Welcome to the audit. My name's Tony Hong. I'm a licensed CPA. I'm the founder, owner, operator of the CPA Dude. We file and review thousands of tax returns each year, and along the way, we find a lot of mistakes, and that's where we do a lot of tax strategy and planning. In today's episode, this was a new client who came to us. We've saved him a ton, but before then, oh my goodness, he missed out on so much in tax savings. So he's a single guy, real estate investor, and the tax code was made for this dude, but his past CPA didn't leverage the tax code like he should have. So today I'm gonna go over all the items that could have been huge opportunities that we fixed for him when he came to us. First issue that we found already, paid $105,000 in taxes when that should have been way lower, near zero, at least half. I'm gonna show you what are the things that he could have done to save this. All right, and we found our first culprit already on the Schedule C. So Schedule C this is when you're a sole proprietor and he's a real estate agent. Right here, he made $60,000 of income as a sole proprietor. And this is just issue number one. Like, I would like to understand, why are you not an S corporation? Because he could have saved a ton in self-employment taxes. This cost him $4,000 in taxes by having the wrong entity structure. So let me explain. An S corporation, unlike a sole proprietor, allows you to reduce the amount of self-employment taxes that you pay. When you're a sole proprietor, you have to pay both the employee and employer side of self-employment taxes. So that's Social Security Medicare at 15.3%. Now, what an S corporation allows you to do is actually separate a portion of it. Part of it can go as wages and the rest goes as distribution. Only what you pay yourself on wages is subject to self-employment taxes. Everything as a distribution, all of that is 15.3% tax-free. You only have to pay income taxes on that. And my dude here did pretty good on the year. He made $87,000 as a real estate agent, but if your CPA actually knows what they're doing, they have to be a little bit more analytical. So for example, here's mistake number 2 that I see here. Car and truck expenses. How can you be a real estate agent and have $0 in car and truck expenses? Last time I checked, a real estate agent is constantly driving to show their clients properties to sell. So say you drive 10,000 miles and using 2026 rates at 72.5 cents, that's $7,250 that he's missed. So he's missed $4,000 as an S corporation, $7,250 here with car and truck. Let's see what else we're gonna find. Oh man, I am just finding a ton here. This is not good. So the next one is insurance, box 15. Like, how does insurance not have any of it? Like, as a real estate agent, I would probably want general liability insurance instead. So this is like the key part of having CPAs who prepare taxes versus like business owners or operators who actually know what's going on. Like for myself, I would have all the insurances possible. And this just continues. I mean, we're off to a hot start. I'm curious what else we're gonna find here. So we got legal and professional costs now too. It's just like, dude, you have a CPA who prepared it. I literally see the preparer's name on here. Why aren't you writing off the CPA fees? I mean, all these fees are technically tax deductible. Now we got another one, box 18, office expense. I'm pretty sure you're sending out stuff like flyers, get materials, printing papers to get signed. That's another part. I mean, that could be another easy $1,000 legal and professional fees, another $2,000. That's another $3,000 that we missed here at this point. Insurance should be at least $500. All right, now I think I just found a potential red flag for an audit right here. And we got travel at $13,000. So $13,000 for an expense of one category compared to the actual total amount of revenue. This is super big here and a flag for the IRS. So let me go calculate this. That's roughly 14% expense. And with the IRS, they may likely flag that. That's a big, big no-no. So for you at home sitting here, if you have any big expense category that's relative to your revenue, make sure it actually makes sense and have the proper receipts to back it up. And then we got meals here. My goodness, meals 208. I know it's only 50% here, but like, dude, I'm pretty sure you're gonna take out your clients for more than that. I mean, I would expect that number to be at least $4,000, especially as a real estate agent. So there's another opportunity about $3,800 that could have been missed here. I would at least have asked a question like, how much could we have missed here? Oh my goodness, this is just not pretty. So now another big one that could have been missed out. This is, I'll be kind here, but home office expense, $810. I'm like, dude, the IRS gives you 300 square foot up to $5. That's $1,500 minimum. So this is at least a $700 miss, if not a lot more. I'd love to see how that was calculated. So on this Schedule C here, you can see that we marked this bad boy up. So we're missing car and truck expenses, Potential insurance, legal and professional fees, I'm pretty sure it's missing there. How didn't we have any office expenses? We got travel that's missing, or almost too much, sorry. We got travel that's just very high, meals that seem low, and the home office expense being very low. Lots of missed here, and the big part here is the S-Corp election. With an S-Corporation, it could have saved them $4,000 at least. I don't know how many more episodes I could be doing of this. This is kind of just giving me like heart attacks almost. Oh my goodness. Qualified business income deduction at $410 makes no sense. So what the qualified business income deduction is essentially that if you have a small business, sole proprietor or single member LLC, even S corporation, the IRS will give you a 20% deduction on your net income. What I literally just pulled up here is $60,000. Why is it not $12,000 is my better question, because 60 times 2, 20% here, is $12,000. That's 400 miss here. So we're looking at $11,500 in additional tax savings that could have happened here. We are finding gold right now. This one is a tall tale sign that no tax planning was done. Obviously, I do know that no tax planning was done because this guy's our client now. But here you go, just so you can go track at home, is the capital gains here, $321,000. Like, how was there not any tax strategy to mitigate the amount of capital gains here? For example, what you can actually do is use tax loss harvesting. There's advanced versions of this, but essentially what you're doing is that you're selling bad positions that you have at a loss that will then reduce your capital gain. So for this, there should have been at least some of that, but what we do for our clients is actually to go and get advanced tax loss harvesting where they're able to get more capital losses to offset their capital gains and get the planning in place here. And a small quirk here, there's two camps of it here that I'll explain here. So he actually got a tax refund, but is this a bad thing? Let me explain to you here. You got $12,000 tax refund. So there's two camps of people, as I've been doing this job for so long, is that one, you got the emotional people where numbers make no sense, and you got two, the robots, you know, like myself who just crunch spreadsheets. And how you can see it is that the most emotional people that are like, oh, a refund's good. But in all reality, that was actually money you're getting back, your own money you're getting back with no interest on top of it. So that's the issue there. So at 12,000 bucks, at possibly even a 3% high yield savings account, that could have been $360 in additional savings that you could have had here. But now don't get me wrong, you know, if I were to tell you, hey, you got a tax bill of $12,000, your heart might sink if you're more on the emotional side, like, oh my gosh, I owe so much. But in all reality, you actually want to owe the government because refunds actually sometimes take a long time. So more on that, but let's dive back into the return here. All right, now this is the big thing that I said at the beginning of the show, and I'm excited to dive into it here. So Eric did things right here. He's a real estate professional. He's playing the tax game exactly how the rule book was made. So he didn't do anything wrong here, but the only part here that could have been opportunity is if his CPA would have told him about this one key thing that could have saved him probably a ton in taxes right here. And this is the biggest weapon on his tax return that I see here. And we're on Schedule E right here, row 18, depreciation. So he's got two rental properties. One took only $5,000 and the other one took about $2,600 of depreciation. And what he could have done here, especially if you're a real estate professional, is that he could use a cost segregation with bonus depreciation to offset a ton of income. So let me explain this here. Depreciation is the ninth world wonder of the world. Compound interest is eighth, but this is how the rich don't pay taxes. And what you're able to do, use depreciation, which is a non-cash expense, and you're able to take a huge amount of that deduction the first year, even if you didn't pay for it. So say you bought $1 million house, did 20% down, he only paid $200,000 of it, but he can go get $400,000 as a tax deduction, even though he didn't pay for it because the rest of it's on loans. So this is the key secret of how the rich don't pay taxes. So if he would have done the cost segregation bonus depreciation right here, he could have wiped out his whole entire tax bill more likely than not here. This minimally could have been $100,000 here that he could have saved. And that would have just cleared out a chunk of his taxable income. Now there's more to be said here. So like we do a ton of real estate with other clients, and sometimes I just see things like, for example, another one here is just the insurance line. Like, did they ask to due diligence of like $264 for insurance? Just seems super low. So there are things that you want to make sure that you're seeing on the tax return and actually getting it done right by your CPA. Otherwise, you're just leaving money on the table. Another one here is utilities on property B here. $238. Should this been a lot higher? If you're paying for the utilities, that's at least $2,000. So that's another $1,800 in missed expenses here. Now we beat the crap out of this tax return, but we're gonna keep on going. We're not done yet. I'm here to find every single penny that's possible out here. So good old health savings deduction here. That could have easily been $3,000 if he was on a high deductible plan, which I would hope so. I mean, he's a single guy, young guy at that point. Why not? Here's another big issue right here is this 16. He probably had a SEP IRA, but if he would have been an S corporation, he could have been a solo 401k and he could easily put $20,000 away instead of $9,000. So that's a $10,000 missed deduction opportunity there. And here's another area of potential opportunity here. Like I told you, he had $300,000 in capital gains. He has a net investment income tax. So when it comes to taxes, some people think that it's all income tax. There's actually a whole bunch of different taxes on your tax return. So there's capital gains tax, there's normal income tax, self-employment taxes, and this one is the net investment income tax. This is 3.8% if you're making too much money making passive income. So this could have been easily wiped out, $5,800 that could have been wiped out if he would have deployed advanced tax loss harvesting strategy. All right, so there we have it. The total is just astronomical here. Now this is my client before he came working through us. And I'm glad he came to us because we can save him a ton in taxes. If you're interested in seeing if you're leaving money on the table, feel free to book a call with my team. What we do is called a tax savings blueprint. And what it is that we essentially just go through your returns. 3 years of this, seeing what you missed, also reviewing what you do this year. And we show you how much you can save by working with us. And this is 100% risk-free. If we don't find at least how much we charge you, we just refund you in full. So if you're interested, click the link below. And also, if you're interested in getting your return audited, feel free to apply and we hope to see you on the show.